Sunday, February 16th, 2020, Monaco 64, home of alternative economics and contrarian views. Today I want to talk about the LIBOR phase out. This is what the Bank of England blog, the Overground, said in September of last year. And I quote, "Use of LIBOR remains widespread and disposes risks to market stability." So before we go further, let's look at what LIBOR is. Well, it stands for London Interbank Offered Rate for unsecured loans. It's a benchmark that's been used since the 1980s all around the world. I know it's based in London, but it's very important for the whole world financial system. And it's a benchmark, of course, that is used to set loans to consumers, loans to corporations. It's used to set contracts, derivatives contracts. It's used to set bond issuance, all kinds of loans, anything to do with borrowing, lending worldwide. It's done in different currencies. Of course, the dollar is the biggest, section of this market. Why are they trying to phase LIBOR out? Well, LIBOR got a really bad reputation during the financial crisis as it was the rate charged amongst financial institutions for unsecured loans. That rate spiked massively during the financial crisis because financial institutions had no more confidence in each other. And basically what the people who worked in this market, there's a panel of banks that come together once a day to decide where the LIBOR fixing for that day is. And what they did was manipulate the rate lower. Big scandal, the LIBOR scandal. I won't go too much into that. There's a lot of information out there you can look into. And even some of the central banks were said to be involved, like the Bank of England. So it has a very bad reputation. So the regulators, central banks, Fed, Bank of England, BIS, FCA in the UK, they all decided it was better to phase the market off LIBOR. And they have some replacements, but the problem is that the replacements are not really the same. They don't stand for the same thing that LIBOR stood, which is unsecured loans. And the 3-month LIBOR rate was used a lot. I remember working in the city in the early 90s already. I could hear people talking on the phone. I was a futures and options broker. I didn't work with OTC derivatives, but you could always hear people saying, so this swap is going to be LIBOR plus 3-month LIBOR plus 50 basis points. So they're having problem. Wean the market off LIBOR. One of the comments in an article that I've read in the FT says that there's still a LIBOR addiction. And from what I've read, the regulators, the central banks, the BIS, they're getting concerned that the market's still using LIBOR too much. And they have to get off LIBOR by the end of next year, 2021. So what replacements have the market regulators kind of provided for LIBOR? Well, there's two major ones. One is called SONIA, SONIA. That's the Sterling Overnight Index Average. It is unsecured, but is overnight. The participants in the market, the lenders, the banks, the insurers, they still prefer a term rate, meaning 3 months, 6 months, or 1 year. They don't like working on an overnight basis. Yes, there are ways to synthetically make the overnight rate a 3-month or 6-month and a 12-month. I won't go into that. It's very complicated. I don't even get a lot of it. The other one is sofr, sofr. That's the one for US dollars. That's the one the Federal Reserve is pushing. That stands for Secured Overnight Financial Rate. And I would say that the biggest chunk of the LIBOR market is dollar-based. So just notice here, it's an overnight rate and it's secured. LIBOR is unsecured and it's a term rate. It's not overnight. It's 3 months, 6 months, 1 year. So it's almost like comparing apples and pears here, and that, in my opinion, is the problem. The other problem is familiarity. The market participants, the lenders, the banks, the insurance companies, the traders, they're used to LIBOR, but they're not really taking this transition seriously. And now I'm going to go through a few articles that I found that show me that regulators, central bankers, BIS are concerned about this transition, and it could impact not only the markets, but consumers who take on mortgages, who borrow consumer credit, also corporations who borrow. It could be a really huge problem. First article I saw was on the fca.org.uk website. That's the Financial Conduct Authority. Right now, the chief executive of the FCA is Andrew Bailey. He will become governor of the Bank of England on March 17th this year. And this is the transcript of a speech he gave at the Securities Industry and Financial Markets Association's LIBOR transition briefing, not in London, in New York. And that was July 2019. Here already, he's showing concern about the transition from LIBOR to other benchmarks. I think it's significant that he went all the way to New York to speak about this to the Securities Industry and Financial Markets Association last July. I will put a link to these articles that I'm looking at below in the description so you can read them fully. So one of the most important comments he made in this speech was this, and it relates to the United States, and it makes sense because he was in New York. And it says, this is particularly true for consumers. In the United States, most floating rate or adjustable rate mortgages are tied to LIBOR. So when I read that, it raised some red flags for me. So I've looked into the US adjustable rate mortgage market. A lot of times they're called 5 and 1. What does that mean? Well, the the teaser rate is fixed for 5 years sometimes, but then after that it becomes adjustable or floating rate. So how big is this market? How big are the mortgages? Well, Market Watch, February last year, has an article. It says the average adjustable rate mortgage is nearly $700,000. So keep that in mind. The other article I saw was on housingwire.com, and this is from January this year. It says U.S. mortgage debt hits a record 15.8 trillion. So how prevalent are these floating rate or adjustable rate mortgages? They're under 10% of the whole U.S. mortgage debt. But for example, in California, the adjustable rate mortgages or floating rate mortgages are 18% of the whole mortgage debt. And as you saw, a lot of these mortgages are huge, with an average of $700,000. So I thought that was worrying. This is one of the points of his speech that I thought, well, this is not great. This is not good. The other point that he made, and this just goes to show how this is going to impact the real world, is when he says, expect to hear from your bank about LIBOR transition. So for UK participants in UK markets, I have two messages as the next phase of LIBOR transition approaches. If you're a LIBOR borrower, you should be expecting your bank to contact you about the change ahead. Put simply, banks should be discussing with you loan products that do not rely on LIBOR. If you are a bank lending LIBOR to corporate and retail customers, you should have plans to explain the forthcoming change to your customers and be explaining the potential risks of continuing with LIBOR. So this phase out has been going on for years. They've been trying to wean off the market for years. And this was in July last year, just before the repo crisis began in September. And I'm going to come to that later and why I think a lot of the problems in the repo market could be partly related to LIBOR, maybe not completely. The other point he makes is the tough legacy. So legacy contracts based on LIBOR are contracts that have been taken before the end of 2021 but run through that period. He talks about how the market for these products could become highly illiquid, meaning it will be very difficult to get a decent price and liquidate that contract. He thinks it's a tough legacy, so that's why he's warning people not to put on LIBOR contracts. Try to avoid LIBOR contracts going into the end of 2021. Right now it's too late because a lot of them are going to run through the end of 2021. And the other thing about LIBOR, the LIBOR market, the market for unsecured term loans amongst financial institutions has almost disappeared since the financial crisis. There's a lot more overnight secured lending or secured term lending. So Mr. Bailey points out that these LIBOR rates a lot of times have no basis in reality. They're not really reflecting the real world, even though they're still using it, and it's crazy. So let's look at his conclusion. At this speech in New York last July, he says, let me emphasize some points again. The base case assumption should be that there will be no LIBOR publication after end of 2021. And I think they're starting to threaten people with regulatory action. I'll come to that in a minute. So this is what he says at the end here. Even if LIBOR does continue for a further period after end 2021, it would have changed. There is a high probability it will no longer pass regulatory tests of representativeness. What I was talking about, does it really represent the real world interest rates? Markets for LIBOR-related contracts are likely to have become highly illiquid. It may not be usable in new contracts. The ability to hedge outstanding LIBOR obligations and claims is likely to have been impaired. The future of those still on LIBOR will be more uncertain than ever. Transition comfortably before end of 2021 is a better choice. So how big is the LIBOR market? Well, according to the FT article that I got from January this year, this is how big the LIBOR market is, and this is what they say. It is not just a UK issue. It says global authorities urgently want markets to move off using LIBOR, which underpins, and wait for this, the pricing of as much as $400 trillion of products around the world, from loans to derivatives contracts. So that $400 trillion is probably even more. We know that the BIS and the central banks changed the accounting rules for derivatives, the notional amount of derivatives after the financial crisis. This is probably more like 1,000 trillion. The world economy GDP is around 80 trillion, so keep that in mind. And this is not me saying this, this is the FT article here. So this article, of course, is from January 2020, January 16th. So that speech by Andrew Bailey was July last year. So the article says UK regulators launch fresh push to switch away from LIBOR. So they're still not succeeding in weaning the market off LIBOR. Banks have until September. They've given them a deadline to stop issuing cash products linked to sterling benchmark. So with that, let's go to an article by the Bank of England blog called Bank Overground. That was written on 30th of September 2019. How prepared are markets for the end of LIBOR? So, and they're just talking mostly about Sonia, the sterling market, because that's what the Bank of England has to keep an eye out for, even though Andrew Bailey went to New York to emphasize to the market participants in the US that it's important to get off LIBOR. So as you can see here, chart A, this is from the Bank of England, and this is from the Bank of England. Firms continue to write new LIBOR contracts despite clear risks to its existence after end of 2021. Total value of contracts referencing sterling LIBOR cleared through LCH. So you can see how from April 2018 to August 2019, outstanding stock referencing LIBOR actually increased. So it's not smooth, this transition, and it looks like people don't want to transition away from it. So to finish off this report, just want to try to link this transition from LIBOR and the problems in the repo market that arose in September, a couple of months after Mr. Bailey's speech in New York. The repo market, of course, is where financial institutions on Wall Street in the City of London borrow and lend to each other using collateral. So they're secured loans, and they're usually overnight. Of course, there are term repos, but they're not as prevalent. They're usually overnight, day to day. And don't forget, they're secured by usually U.S. government securities or treasuries, sometimes mortgage-backed securities. And then we have the derivatives market, the loan market, the mortgage market, the insurance market, consumer credit market, which is more than probably 400 trillion, as I said earlier. And they're still referencing this rate, LIBOR rate, which is unsecured, and it's a term rate, 3 months, 6 months, or 1 year. Still referencing this rate from a market that really doesn't exist anymore. And I'll tell you an anecdotal evidence that I have. When I used to be a futures and options broker, one of my biggest clients back in 2012, he used to be one of the guys who set the LIBOR rates every day, and he used to trade with me Euro-dollar futures contracts, which are a hedge for the LIBOR rate. And he used to tell me, Mario, there's no more LIBOR market, but we're still setting this rate. So this is not new. This has been going on for years. So what, in my opinion, could be the link between the transition away from LIBOR and the troubles in the repo market? Well, and I'm not saying this is the reason why the repo market has been so unstable since September and why the Fed has had to intervene. I'm just saying that it could be one of the reasons, because you've got people still highly dependent on LIBOR contracts, which are based on term rates, 3 months, 6 months, 1 year, and unsecured. And now you have the new reference rates that you're supposed to use, especially the sofr, which is the American, or a dollar-based one, which is a secured overnight financing rate. So what's the repo market? it is general collateral or secured overnight rate. That's where the bulk of the repo market is. So could it be that all these people that have put themselves into these LIBOR contracts are saying, oh my, I need to like protect myself, so I need to go into the repo market? And it's interesting that the trouble started a few months after Andrew Bailey went to the US to warn the market participants, the people who are involved in not only the repo market, but in using LIBOR. So my conclusion is that there is a problem out there. The regulators are concerned. And as you saw, they were concerned in July, Andrew Bailey, and they're still concerned now, according to the FT article from January 2020. So it's not something that's talked about that much, but it's something that could be huge. The potential for instability, and that's not me saying it, it's the regulators, is great. And that's why I think the problems in the repo market are going to continue. And it will be very interesting to keep track of this. I'm going to keep track of this a lot more now. I think it could be a potential problem for stability in the markets. In the past, I used to think that listening to my client 8 or 9 years ago saying that LIBOR market doesn't exist anymore, I thought, well, no one's using it anymore. But that's not true. It's crazy. They're still using a market that doesn't really represent a reality, as Andrew Bailey said. If you enjoyed this video, make sure you hit the like button, share it far and wide. Think about subscribing to the channel if you haven't yet. And you can also follow me on Twitter, Facebook, Steemit, BitChute, and DTube. I wish you all a great rest of the weekend. Take care. Bye.